Hey there, investors. Ever dream of owning a skyscraper or a shopping mall? Now hold your horses. I'm not saying you need Warren Buffett's wallet to dive into real estate. That's where REITs come in, folks. REITs, or real estate investment trusts, are like these awesome baskets holding a bunch of properties. Think apartments, office buildings, you name it. These REITs, they're publicly traded companies just like your favorite tech stock. But instead of gadgets and gizmos, they own, operate, or finance income-producing real estate. It's like owning a slice of that shiny new mall, but without the headaches of being a landlord. No late-night calls about leaky faucets, no chasing down rent checks. Sounds good, right? Now, let's talk money, honey. What's in it for you? REITs are required by law to distribute a big chunk of their taxable income to shareholders as dividends. That's right, folks, regular cash flow straight to your pocket. Imagine this, you invest in a REIT that owns a bunch of apartments. Every month, those renters pay their rent, and a portion of that sweet cash flows right back to you as dividends. But wait, there's more. REITs are known for their liquidity. Unlike that fixer-upper you've been eyeing, REIT shares can be bought and sold easily on stock exchanges. Need cash quick? No problem. You can sell your REIT shares just like you would with any other stock. It's like having your real estate cake and eating it too. Now let's talk about diversification, the golden rule of investing. You know the drill, folks. Don't put all your eggs in one basket. REITs get this. They offer a fantastic way to diversify your portfolio beyond traditional stocks and bonds. Think of it like this. You've got some money in tech stocks, some in bonds, and now you add some REITs to the mix. Now you're invested in different sectors of the economy, spreading your risk and increasing your chances of long-term success. Remember, a well-diversified portfolio is a happy portfolio. Section 4. Uncle Sam's Gift, the tax perks of REITs. Now let's talk taxes because nobody likes paying more than they have to, right? One of the sweetest things about REITs is their tax advantage status. Remember how REITs have to distribute most of their income as dividends? Well, that means they avoid paying corporate income tax on that distributed income. That's a win-win for investors. But hold on, there's a catch. There's always a catch, right? REIT dividends are typically taxed at your ordinary income tax rate, not the lower capital gains rate. But hey, it's still a pretty sweet deal compared to other investments. Section 5. REIT, roster equity, mortgage, and hybrid players. This section is crucial for understanding the different types of real estate investment trusts, or REITs, that you can invest in. Now listen up because this is important. Knowing the differences between these REITs can help you make more informed investment decisions. Not all REITs are created equal. Each type has its own unique characteristics, benefits, and risks. There are different flavors to choose from, each with their own risk and reward profile. Understanding these can help you diversify your portfolio effectively. First up, we have equity REITs, the big dogs of the REIT world. These are the most common type of REITs, and are known for their stability and potential for long-term growth. These guys own and operate income-producing real estate, like those apartment buildings and shopping malls we talked about. They generate revenue primarily through leasing space and collecting rents. Then we have mortgage REITs, or MREITs for short. These are quite different from equity REITs. These players are in the business of lending money to real estate owners or investing in mortgages. They make money from the interest on these loans. They're like the bankers of the REIT world. Their performance is closely tied to interest rates and the health of the real estate market. And finally, we have hybrid REITs, the combo meal of the REIT world. These are a mix of both equity and mortgage REITs. These guys invest in both properties and mortgages, giving you the best of both worlds. They offer a balanced approach, combining the income potential of equity REITs with the interest income from mortgage REITs. Section 6. Why REITs rock benefits beyond the bricks. Real estate investment trusts, or REITs, offer a unique blend of benefits that go beyond just owning physical properties. Now let's recap why REITs deserve a spot in your portfolio. They are not just about owning a piece of real estate, they are about smart investing. First off, they offer a steady stream of income through dividends. These dividends are often higher than those from other stocks, providing a reliable income source. Remember those monthly checks from your apartment rentals? With REITs, you get similar benefits without the headaches of property management. It's like that, but without the hassle of being a landlord. No more late-night calls about broken pipes or chasing down rent payments. Second, REITs are highly liquid, meaning you can buy and sell them easily on stock exchanges. This liquidity offers flexibility that traditional real estate investments lack. No need to wait months to cash out like you would with a traditional real estate property. You can access your money when you need it. Third, REITs provide excellent diversification for your portfolio, spreading your risk across different sectors of the economy. This means you're not putting all your eggs in one basket. And let's not forget about the tax advantages. REITs enjoy special tax treatment, which can put more money back in your pocket. This can be a significant benefit come tax season. REITs enjoy special tax treatment, which can put more money back in your pocket. This can be a significant benefit come tax season. Plus, REITs have historically performed well during periods of inflation, acting as a potential hedge against rising prices. This makes them a valuable addition to any investment strategy. It's like having a secret weapon against inflation. With all these benefits, it's clear why REITs are a powerful tool for any investor looking to build a robust and resilient portfolio. Section 7. REIT reality, check. Navigating the risks. Now before you go all in on REITs, let's get real for a second. While they offer a unique way to invest in real estate without the hassle of owning physical property, they are not without their pitfalls. It's crucial to understand these risks to make informed decisions. Like any investment, REITs come with their own set of risks. These risks can vary widely depending on the type of REIT and the market conditions. It's not just about the potential returns, it's also about understanding what could go wrong. First off, they can be sensitive to changes in interest rates. When interest rates rise, borrowing costs for REITs go up, which can impact their profitability. This is because REITs often rely on debt to finance their property acquisitions and developments. When interest rates rise, borrowing costs for REITs go up, which can impact their profitability. Higher borrowing costs mean lower profit margins, which can lead to reduced dividend payouts to investors. Second, REIT dividends are taxed at your ordinary income tax rate, which might be higher than the capital gains rate on other investments. This can affect your overall return on investment, especially if you're in a higher tax bracket, which might be higher than the capital gains rate on other investments. Therefore, it's essential to consider the tax implications when evaluating the potential returns from REITs. And finally, REITs are subject to sector-specific risks. For example, an economic downturn could hurt the demand for office space, impacting the performance of office REITs. Similarly, retail REITs could suffer if consumer spending declines. For example, an economic downturn could hurt the demand for office space, leading to higher vacancy rates and lower rental income. This can significantly impact the performance of office REITs, making them a riskier investment during economic downturns. Impacting the performance of office REITs. It's not just about the broader economic conditions, sector-specific factors can also play a significant role in the performance of your REIT investments. It's important to do your homework and understand the specific risks associated with each type of REIT before you invest. This means looking at the underlying properties, the management team, and the market conditions. So there you have it, folks. REITs can be a potential gateway to real estate riches, but they are not without their risks. Remember, knowledge is power. REITs, a potential gateway to real estate riches, but not without their risks. Remember, knowledge is power. The more you know, the better prepared you'll be to navigate the complexities of REIT investments, but not without their risks. Remember, knowledge is power. Do your research, understand the risks, and invest wisely. This way, you can make the most out of your REIT investments while minimizing potential downsides. Do your research, understand the risks, and invest wisely. Happy investing!